there and everything else, right?
In the interest of good timekeeping, I think we're going to kick off as people come in with their coffees. But welcome to this. This is the second panel of today. We're looking at the Canadian covered bond market. We're looking at broadening the base. So we'll be speaking about the sort of the big 7 issuers, but also about the potential for the smaller banks and credit unions to be issuing and joining the covered bond market as well. To do this, we have a sort of great panel lined up for you today. To get started, I will ask my panelists to introduce themselves, starting with Michael.
Hi, I'm Michael Lay. I work at Bank of Nova Scotia in debt capital markets.
My name is Tim Sharon. I'm the treasurer at Equitable Bank.
Alberto Mendes, treasury manager at Van City Credit Union.
I'm Harpreet Sahot. I'm a portfolio manager in the fixed income area at ECBC.
And Chris Summers, I am a credit research analyst, sell side at BMO Capital Markets.
Now, just a bit of housekeeping. We've got, if you've got a burning question, please just put your hand up. If you're a bit shy to ask, there is a way to ask a question through the app. And we also have a poll that I will ask you all to answer. The poll for this panel is: in 5 years' time, the Canadian covered bond market will be A, the same it is now, mainly big banks and European investors; B, plus a handful of smaller banks, but nothing to get too excited about; or C, lots of diverse issues and a developed Canadian dollar investor base. We hope. But please submit your answers through the poll, and we will come back to that one later on. Now, to get started, I'll ask Michael if you could just give us a sort of a bit of a background and a brief history of the Canadian covered bond market.
Yeah, I'm happy to. I would say, to start, our bank has not issued a Canadian dollar covered bond. And I feel like I'm copying a little bit one of my competitors' comments from the panel yesterday, Greg McDonald, who's in the audience. But our challenge for us, by and large, has been in Canada, the pricing, in that we've found that the Canadians are very comfortable with the bank's credit exposures, and they do not feel the need to pay up to the level that we feel the collateral is worth. I would say that, looking back, I think the first covered bond happened in Canada, I want to say in 2007. Both TD and RBC have been active, and this year we did have BMO issue as well. I think that we receive, I wouldn't say often interest from Canadian investors. I think we do receive some interest from Canadian investors, but again, I believe that they're pretty happy to earn the extra spread that come with either our existing deposit notes or even looking at the senior unsecured market in the US, or even also, I would say, NVCC when we have issued in the past.
Chris, I'll bring you in here. I mean, sort of, looking at the Canadian covered bond market, it was sort of issued on a contractual basis until the legislation was implemented in 2013. What's sort of been the activity in the market since then, broadly speaking? So not just in dollars, Canadian dollars.
Yeah, I mean, overall,
currencies.
Canadian banks have done a pretty good job at optimizing funding costs using whatever types of securities are available to them. And I think that with covered bonds, I mean, it's been something that really through 14, 15, and 16, there was a ton of international issuance. And I saw a stat earlier talking about how there's been over $200 billion worth issued overall. I mean, we did a count of it a couple days ago, and so there's about $140 billion of covered bonds outstanding on a Canadian dollar equivalent basis, but about $4.5 billion of that is in Canada. So it's been a product that has seen a lot of international demand and appeal. But when you come back and look at the domestic market, I mean, it comes down, like there's no bad deals, there's bad pricing. But it'll come down and there's a failure to kind of meet between investors and issuers in terms of what is really the right pricing dynamic there.
So, I mean, as you say, the market's grown to a size of sort of over 100 billion euros. I think someone said yesterday 170 or 157 is around there. Canadian dollars, how much more potential growth does the market have?
Like globally?
Yes, globally.
Well, that depends on a few things like quantitative easing. It depends on pricing. I mean, I think that kind of an interesting thing that is going to happen later on this year is we get this new bail-in set of rules, or TLAC, or non-preferred, or whatever terminology you want to use for it. But the reality is that's going to change the pricing dynamic a little bit with senior unsecured debt from the banks, maybe costing banks a little bit more to issue. And if you typically, the way that my simplistic mind thinks about it is a bank is more interested in issuing a covered bond when it's kind of 15 to 20 basis points tighter than an unsecured bond is. And currently right now in Canada, we're around 10 to 15 basis points. So maybe not as exciting an opportunity to kind of issue at that rate, but if bail-in comes and let's say it's 10 basis points wider, let's say it's 15 basis points wider, covered bonds not bail-inable, so there is a greater really desire from the bank standpoint to take advantage of that. And so we could see a little bit of growth with that, but I think that's sort of a post-bail-in thing and is going to be used opportunistically versus really being able to make some broad claims about, oh, it could easily be a $200 billion market.
Yeah, and just echoing both your guys' comments on the pricing, that's really been sort of the issue in the Canadian market here. I think to pay an additional, I mean, for us, we're comfortable investing in the big Canadian banks, those that have issued covered bonds thus far. If we're going to take the credit exposure or the name exposure, given how big the banks are in corporate bond issuance in Canada already, I'd rather have that additional 10 or 15 basis points and be owning the deposit note rather than owning a covered line like the AAA, the extra security. All of that doesn't matter to me quite as much, or it's not worth paying say 10 basis points to get it. Yeah. For us, we've looked at it as really just a value play. I think we've participated in or owned the sort of 3 or 4 issues that have been out there at one point or another, but it's just really been a relative value thing for us in the past. But that being said, with bail-in coming in the future, that dynamic could change. Yeah.
Michael, anything to add on sort of bail-in and how attractive or more attractive is that going to make covered bonds, in the domestic market?
Yeah, I mean, I think we've all talked about the pricing, and the question is where's it going to be, 10 or 8 or 12 or
40?
Whatever it's going to be, or wider. I think that over time, people will start gravitating towards better rated stuff, especially I think as we advance through the business cycle. So if you think about Canada, I'm not saying that we were immune from the struggles that the world went through 10 years ago, but we certainly, I would argue, had a bit of an easier ride for some of it. It feels that we're a little bit, I think, longer in our business cycle than some of the other people, particularly our neighbors to the south. And I would argue that I think in Canada you will see finally some differences in pricing based on rating. The Canadian banks forever have traded sort of in this very tight band. You're starting to see some rating differentiation between them, and I think over time you will find investors starting to pay up for better quality stuff. But I think the overall spread levels all need to be wider for that to happen. I think at these tight levels, extra basis points really make a difference. So I think that with wider spreads will come more differentiation, but how much exactly it will be, it's difficult to say.
Emma mentioned in her opening remarks the 4% asset encumbrance limit, and Jeremy Rudin from OSFI yesterday was discussing it. How much of a constraint is the 4% limit? I mean, as we heard, it's a misinterpretation and an arbitrary figure. How much of a constraint is it on the growth of existing issuers to start?
Well, I think that our own bank is probably, we're about 10 billion under our limit, I think. I'd have to look exactly.
So there's quite a lot of headroom.
So we still have lots of headroom, but even looking at the other Canadian banks, again, I don't have the stats for them as much off the top of my head, but I would argue that I can't tell if there's anybody who's anywhere close to their limit. So I would think that there's lots of room and capacity out there for them to issue.
Yeah, I mean, the numbers are, there's a 4% limit, but if you go across all the banks, everybody's collectively at 2.7%. Right. And there's maturities that are occurring every year, so there's not assuming like the same issuance pattern continues, there's not really an issue of hitting that upper limit. Now, where I think that the 4% limit becomes more interesting is when you look away from the largest issuers in Canada, so not at the big 7, you look at the smaller organizations. If you've got a 4% limit and you've got a $20 billion balance sheet, I mean, you can do one bond. And you're not really going to get the investor base that you're looking for, and you're not really going to get a cost advantage to doing that. So if you want to encourage a bigger like covered bond marketplace, I mean, maybe a tiered limit system actually kind of makes sense.
Yeah, I would also just sort of echo that, right? So the 4% as well is applied on total assets. So there's a bit of a special, like Equitable Bank, we're a specialized business, strong mortgage underwriting. and the 4% of the mortgages. So if you translate that to some of the larger banks, you're into the 10 or 20% of the mortgages sort of eligible for a covered issuance. So it is quite a constraint for an entry decision.
Yeah.
And I think we're well aware as well, like if we were to want to enter the market, we'd want to sort of give the investors what they want, which is a regular issue of a good size. And so today that's, a difficult decision to make. I agree.
Yeah, and I agree as well. Of course, there are many considerations when you decide to enter the covered bond market, and certainly the 4% limit is one, particularly for these smaller players, because of course there is an impact on the economics of the whole setting up the whole program if your ability to issue in the long term is limited, and if you are not going to be able to issue on a recurrent basis. That's a problem as well, particularly if your balance sheet is small, and then you can only issue maybe for 100 million, and then what happens next? That's a problem. And the main issue with the 4% limit is that the impact is not even across the spectrum of potential issuers. Always the smaller players will be affected more just because their balance sheet will not support continuing issuances in the long term, and that's a problem. And of course, at the end, decision makers will have to look at the whole, the entire value proposition of a covered bond before entering the market. But for me, the most relevant question is whether your balance sheet can support a sustainable program. That's the main issue. And if you don't have the critical mass, well, you might start looking at different alternatives. The covered bond might not be for everyone. Some players might be in the borderline saying, well, maybe if the 4% is moved up, I might enter. But for other players, the smaller financial institutions, it might be just not interesting. And maybe the 4% limit is an opportunity for the smaller players to look themselves at the mirror and say, well, maybe I should be using my assets to look for alternative funding options, or that would not tie my assets in a program like this. That's how I see it.
Tim and Alberto, I'll stay with you now. If I could just ask you both to give us a bit of background on your institution and what your sort of current sort of funding mix is.
Yeah, so we are a non-branch-based lender in Canada. We're primarily focused on residential with a commercial lending business. And on the funding side, which is probably more interesting to this room, we have CMHC programs involved, including MBS and CMB. And the rest of the balance sheet, mostly alternative assets, alternative mortgages, are funded with a mix of brokered deposits, including GICs and high interest savings to a lesser degree, as well as we have a direct bank that we launched online in the last 2 years, which is doing well. And there's some other wholesale things. We have a deposit note outstanding and access to ABCP programs. So primarily, those are the tools. So when we look at our next option, I think one thing we can bring, if we were to make the entry decision, being a BBB issuer, we'd probably not issue a AAA bond if we did a covered. And so there would be a compelling yield play there for an investor if we were to enter that market. I would also say on the asset side, where we play is not direct competitors to the banks. What we do on the asset side is we originate mortgages that are traditionally outside of what the banks would see as worth their energy. And so we spend an awful lot of time underwriting mortgages for people like new immigrants to Canada, perhaps, who are professionals and don't have a Canadian credit rating. So the assets themselves turn out to be extremely good. So as a bank, we have a stronger capital ratio than our peers, than the larger peers, and we have lower loss rates on our mortgages. So it's actually a pretty good asset class to use in a covered pool. So that's kind of where we are.
Yeah, I just say in my case, just for the benefit of the foreign audience, Vancity is a federally regulated cooperative credit society based in Vancouver. That's how we got the name. Not very creative, I guess, but has been a very successful credit union. Is the largest in Canada. In terms of assets, we are about 21 billion. So I mean, it's sizable, but nothing compared with the big six. And of course, the size of the balance sheet, as I mentioned before, could be a constraint to issue in the future. What we have done, for your question, is to try to diversify as much as possible our funding base. So over and above our very stable retail deposits, we have been, we started diversifying our funding sources by getting credit facilities from other financial institutions with our central as well. That was the starting point. And then over the years, we have managed to have a footprint on the wholesale funding market. We have been running a commercial paper program for a number of years already that has been very successful. From time to time, we issue short-term deposit notes, and we have been in the securitization, active in the securitization front for many, many years, over maybe 15 years. I think we were the first credit union that was approved as an HMBS issuer. So we have been there for quite a long time. And the way I see it is that we have paved the way to diversify in the future. I don't know if the covered bond will be, the next step, because of the constraints I just mentioned. But if that were the case, I would say that we had kind of the basic building stones to move into another type of funding option, because we have the footprint on the wholesale funding market. The other thing is valuable to get started, and then also having been exposed to the securitization process, I think that provides a lot of good background, because the knowledge and the systems can be repurposed for the purpose of eventually issuing a covered bond. But honestly, the way I say it is still not in our horizon in the short term.
Okay. Chris, Michael, are you sort of aware of any of the other Canadian institutions that haven't issued covered bonds that are looking at implementing a program, or what's the sort of lay of the land with others?
Well, I mean, I haven't heard that specifically. I mean, I think that, one of the unique things about Canada is when you think about senior issuance, generally they tend to be 100% self-led by each dealer. So within the banking community, obviously there's a good community of issuers, a lot of which are on that, or all of which are on that screen over there. And I think that, the challenge, and I don't mean to speak for the issuers that are on the panel, but the challenge is, I think, comes to the size of the issuance you can do, but also the cost, right, of setting up the program and the cost of monitoring the program. Because, I mean, I'll be honest with you, I didn't know a ton about covered bonds before I got ready for this panel, and I still don't know a lot. But one thing I was incredibly impressed by is the amount of detail that's available on each one of the covered pools via the CMHC website. You can go in and you can get to everybody's investor relations site and look through the pools. And the regional, the amount of detail just to administer that program is quite amazing to me. So I think that you really need to see, we talked earlier about cost, you really need to see demonstrated savings. But I also think, unfortunately, the savings on the setup and the admin have to go down a bit too before it would make any sense for some of the smaller institutions to get active. Like, I don't know, Chris, would anything different? Yeah.
Yep. Yeah, I was just going to say, there's a bit of a kind of chicken egg thing too, where Bob on the previous panel, he was saying about how he'd like to see people issuing more, and that's what would create more of a market. And it's the same kind of thing. Like, if the Canadian banks were all doing more issuance, there would be more kind of specialist investors looking at these and likely provide more opportunities for further issuance. But that market's not going to get created unless there's enough product to do it. And so I think what we've seen so far is really banks kind of just dipping their toes in where they have seen demand. And I mean, one of the things that we have in Canada that's no different than anywhere else is that covered bonds serve an important purpose in HQLA LCR programs as well. And so, but there's only really 6 big banks in Canada that report an LCR number. So it comes down to how many covered bonds does that particular market need, and are you going to get into traditional sort of real money buyers into it as well? And that will happen with increased amounts of issuance, but that's going to come at a cost. And when you've got all these other funding avenues open to you, why are you going to do it?
Why bother, right? Why going through the motions of setting up a complex program and then having the recurrent operational burden to maintain it and the recurring costs associated to that? So yeah, that depends where you stand. The bigger players might say, okay, that's fine, we can absorb that. But for smaller players, it's a different proposition altogether.
Yeah, I think balance sheet size is a key determinant, right?
For
So,
sure.
we're similar size, 20, I think I heard you say 21, we're similar. At some point, when you get small enough, it just absolutely doesn't work. The other factor that unfortunately comes into play is what we saw in Canada. My anniversary of my treasurer role is 1 year ago this week, which is when some of the home capital issues started, if people remember. So the growing
Happy anniversary.
Yeah, thanks. It's more fun this week than it was a year ago. When credit spreads have widened, right? So for one of our peer banks, the larger ones, the differential is really not there to compel them to issue in Canada, we've heard. It's really not there to compel an investor to buy that bond. Whereas somebody with a wider spread, I think that there's more opportunity. So the balance of the balance sheet size and how that the cost of setting up a program get amortized, the cost of diversification and having those other tools available, these things are all starting to get, I would say, interesting. I would hope, frankly, that our spreads, our unsecured spreads come in, so maybe this isn't an issue, but if it doesn't, I think this is something that we're going to keep looking at.
Harpreet, just for the investor perspective on sort of, how much demand there is for, sort of new bonds in the market.
Smaller issuers and
Yeah,
that kind of
smaller
thing.
issuers.
Well, I mean, you bring up the point about home capital, and even more recently, larger than home capital, but still a smaller bank in Canada was Laurentian, started to have a few issues around their mortgage pools about like 4 or 6 months ago. And that's one of the concerns that we've had internally if there were smaller issuers. We're very comfortable with the larger Canadian banks. We've done the credit work. We know they have very strong underwriting standards and all the rules that they have in place for gathering documentation. As with some of these smaller institutions, I'm not picking on you guys, but we don't have that clarity, and we know that they don't have the amount to invest or spend on the information that they're gathering on the mortgages that are in their pool. Like it's a concern for us after what came up last time, with Laurentian, which would potentially scare us away a little bit from some of these smaller issuers coming to market.
Although to offset that concern, part of the framework, the framework is that there is going to be a lot of information available to investors to make a more educated decision on what to do, right? So if any player decides to enter the market, hopefully there will be enough disclosure for you guys to make a more informed decision. So I see your point completely, but at the same time,
Yeah, I mean, I feel like
there are some mechanisms within the overall framework to help you decide, have a more informed decision.
Yeah, I think it's more of a sense or a potential sense from investors that what's Equitable Bank doing? I don't know that much about their processes or Vancity for that matter, and that could be enough for folks to step back, or in order to go into that kind of a product, the additional spread that might be required. It's always that balance, right? So what's cheap to me isn't cheap for you,
Exactly.
and striking that balance could be the challenge.
And what's cheap to an unsecured investor isn't the same thing as what's cheap to
Right.
an ABS investor,
Exactly.
for example, on it.
Exactly.
I think the issuance process, right? I mean, we've got a bit of homework to do, I think, given we don't have a huge fixed income investor following, and some guys like yourself. I think
Definitely.
absolutely we know we have homework to do there, but I think fortunately there's a good story behind all that. So I think we would just have to get that story out.
Yeah.
And to be out to the market as well, and you have a presence as well. But your point is completely true.
What about the development of smaller issuance like private placements, sort of rather than just jumbos? Is that is that going to change the dynamic? Are we going to see sort of more smaller issuance?
Again, I would argue it comes down to pricing expectations on behalf of both the buyer and the seller, or the issuer and the investor. In Canada, smaller, less frequent issuers, unfortunately, tend to trade at a slightly wider spread. And I think you get to the point where it's probably not economic for the issuer to consider. The savings aren't there. The maybe having access to the market has some value, and having access to diversify your investor base has some value. But those issues can trade at a significant discount. Even our own bank has a rarely does private placements in Canada. They'll do them internationally, and there seem to be people that have specific needs for specific terms, specific things, and they're willing to pay up for that. Maybe one of them's in the audience, but I've yet to find a Canadian investor who really leads with price when they're looking for something specific. I think they do their best to try to find something that already exists within the existing framework. So I think that'll be a bit of a challenge as well.
Mm-hmm.
No bad deals, just bad pricing.
Good. Now, I mean, we sort of started speaking about before. I mean, outside of Canadian dollar market, the majority of issuance from the big issuers has been in euros. How do pricing levels in Canadian dollar compare with euros post swap at the moment? How is that pricing currently looking?
Well, I checked this morning, and I got to be honest with you, Canada probably looks as interesting to our group as it has in a while. That being said, we this week completed a US dollar unsecured deal, and we did a deposit note last week, so we don't necessarily need any money. But I would argue that right now, the way we see it, actually sterling might be a bit even more attractive than euro. So we see sort of the difference between Canada and the US pretty similar. We see euro maybe 4 or 5 more expensive in the 3-year, and then sterling even more expensive than that. And then in the 5-year, again, we see sterling as the best option, but I think the deals tend to be a bit smaller in that term. So I think the one thing that I would say the covered at the pricing where we think it's value for our bank, or where we think we could clear a small $500 million deal, I just don't think that that's enough for our bank to make it worthwhile. I mean, when we were, all the Canadian banks have shown the ability to print $2 to $2.5 billion deals, in the equivalent of senior unsecured. So I think that it's attractive, but in Canada, it might look okay, but not when you consider all the factors that go into an issuing decision.
Any to add on that, Chris?
I guess there's certainly, I mean, it's cheaper for the banks to issue debt outside of the country, and they have, Canada actually was a generally lower part of the overall bank funding mix in 2017, and I mean, even up until now, it's kind of come back a little bit year to date, but it's these international markets are extremely important for the banks, and I think it's smart from a treasury standpoint. I mean, there's so much cash out there in other parts of the world right now that it's been an easy decision to make to sort of stay away from the Canadian market a little bit. Does that change towards the end of this year and going into next year? Yeah, I mean, my thesis is that it does, and part of that is because bail-in's coming, and I think that the banks are going to find a friendlier buyer base for bail-in in the Canadian market than they will internationally. So again, that supports covered bonds being something that stays a non-Canadian product, at least for the interim there.
The other side of that is that with bail-in coming in, and I mean, for our portfolio, it doesn't make a difference, but there could potentially be some fixed income investors out there that aren't, due to limitations in their policy or what have you, aren't able to buy an instrument like bail-in because of the potential convertibility into equity. And as a result, that could help, bail-in could help develop a bit of a deeper market for covered bonds as being an alternative way to get some of the exposure to the banks.
You guys can tell we get excited about bail-in. It's the greatest thing.
It's been the topic of.
It's been around for a while.
Yeah. Harpreet, sort of, what more can issuers, regulators, and others be doing to develop the Canadian dollar market, and what's on offer from your perspective?
I mean, from our perspective, what regulators could do, I don't have too much of an opinion. I mean, the bank guys might be able to answer that a little bit better, because the regulations for us don't make too much of a difference. So I don't think I have a great answer to that. I mean, generally speaking, if it sounds like they could increase this limit on borrowing, the other or on assets that can be tied up. I guess the other part of that is they could make it easier to issue, given the costs that are involved with setting up that sort of a program. And then the other item might be if covered bonds were to qualify for, I mean, I guess they qualify for LCR right now, but if the regulator were to change, if OSFI or whomever were to change how covered bonds are treated in terms of capital or other items like that, then that could potentially help issuance as well.
I think there's a couple of things that they've already kind of done that maybe just sitting back and just watching a bit is going to be kind of interesting there. I mean, like one of the major shifts that's happened in Canadian financials over the past year or two has been a lot of changes to the way mortgage rules are done, and inclusively in that is changes to the way mortgage insurance is purchased. And with a lower amount of mortgage insurance being purchased, that's limited some usage of some of the government-backed MBS programs that used to get used. And so does that create an opportunity where now there's still stuff that needs to get funded, but this old channel is not as available as it used to be? So does that kind of, I think that in a perfect world, sort of blue sky wise, I mean, from their perspective, it probably would just on its own encourage more covered bond usage, because that's a funding vehicle that works well for uninsured mortgages. But again, it'll come down to that pricing dynamic.
Alberto, I'll ask you and Tim this question, but sort of not on developing the covered bond market, but on sort of mortgage funding in general.
Sorry, what's the question?
Sorry, just, not just on the covered bond market, but sort of how the mortgage funding market in Canada is working at the moment.
Yeah, I think we've seen a slow development in novelty, I'll call it. I mean, we saw the MCAP deal recently, and that was the first deal in how many years? So I think
since the last MCAP deal.
Yeah. So I think there would be an appetite for such a development. I think that, as we've talked, the large banks are probably not going to support that because they have better sources of funding available.
Excellent.
And so that would put the pressure on the small institutions to do it. And I think we're going to see, if anything, a slow creep in that kind of activity for that reason. I think my personal bias, I would prefer to see, we've talked about it already, the 4% limit. If that was to change in a way that allowed small issuers to access a program that investors were immediately knowledgeable about and familiar with, I think that would be a much more helpful way for small issuers.
And to pick up from your last point, I think that's something that we need to do, and this will help stimulate both supply and demand, which is what you want. You cannot only work on one side. For an efficient market, you have to work on both sides. And something, this point is not so technical, but I think it's very, very important that we develop the knowledge pool to, more players are able to understand what covered bonds are about, the markets around, the dynamics, and that's very, very important. And if you look at the case of the CMHC sponsored securitization programs, one of the I think that has been very successful. I think one of the reasons was that there was a lot of knowledge around what to do, the dynamics, or what's the next step. In my own personal experience, I would call a peer I used across the street and say, well, how do you go about this? And that's very valuable to kind of stimulate issuers to enter the market. And like the bigger banks it would be very useful if they disseminate knowledge, which is what you do, Chris. So with your reports, and I think that's very, very valuable. Just open up the knowledge pool.
Before we go on, I think if we can bring the poll question back up, just to have a look at that. So, majority thinking that we're going to have a handful of smaller banks being added to the current list of issuers, which I think is a very positive thing, but not a developed Canadian dollar investor base, according to this. I mean, on this, is there ever going to be any scope for development of the covered bond maple market? Are we ever going to see non-Canadian banks issuing Canadian dollar covered bonds and in size?
I think from an investor standpoint, that could potentially be palatable, because it's one of these items that, again, I mean, we've talked about pricing, I don't want to bring it up again, but it's, it could be a way to get a little bit of spread over what we might get in a Canadian covered bond. And also, if we're suppose we're not particularly comfortable or knowledgeable about some foreign bank and how they operate within their market, but we can do the credit work on the kind of mortgages that they might throw into their pool. It might be a more palatable way for us to own a foreign financial institution without having all of the exposure to what's going on in that region. What is that regulator going to do, and how are they different from OSFI and what we're used to, and that kind of thing. So I could, as an investor, I could see more appetite for that kind of an issuance than a small Canadian issuer being in my portfolio.
Still, the pool of buyers will be very, very limited, right? Those having the capacity to, analyze the framework in other regions, the different regulatory environments. I would imagine that it's not for everyone, that ability.
Certainly, yeah. I mean, we have a pretty deep credit team, and they talk to Chris quite often as well. So I mean, we probably have the capacity to do that, but I can imagine some smaller shops being a bit more challenging.
And on the supply side, right, the changes in Europe might actually create more interest in those issuers coming to Canada, which I think is a huge open question when you see the withdrawal of the buying programs there, right?
Yeah.
Reverting the dynamics.
And I would say too, if you think about the history of the maple market in Canada, go back to, I know it was 10 years ago, but go back to 2007, Canada was the poster child for every bad news issuer that it seemed to exist in the world, and then we went through this wasteland where we didn't see anything for a number of years. And you think about the growth we've seen since about 2012 or 2013 to the point last year we had $15 billion worth of issuance, which was roughly, let's call it between 10 and 12% of our total issuance for the year. And we had, the standard sort of financial issuers. We also had some really good group of industrial issuers last year. And now I think you're starting to hear from investors sometimes that they're more willing to consider maples as less of a sort of niche product and more of a day-to-day sort of investment product. So I personally think there would be support, and I think that the better rated new issuers are, sometimes that makes it a little easier. So I actually think it would go very well.
Well, yeah, I mean, I'd agree with that. I mean, I think that probably Canadian investors are quite comfortable with the credit profiles of the large U.S. banks, and would continue to buy those unsecured versus European banks issuing in Canada, for example. I think that a covered bond would be easier to swallow than unsecured.
Yeah.
Before we move on, we're sort of running out of time here. Are there any questions from the audience for any of our panelists, or any other small banks in the audience that might have something to say about the development of covered bond program? Questions? No? So we'll move on. Last couple of questions. We sort of heard a very compelling presentation from Stéphane Marion yesterday that maybe we want to rush out and buy a shack in North Vancouver. It seems that there is no housing bubble here, and everything is as it should be. Just want to touch on that briefly. I don't expect everyone to be an expert on the housing market, but just how from the sort of bank's perspective, you're looking at the current state of house prices, and whether there's a decline in credit or any effect on Canadian institutions.
Yeah, I mean, I would say anecdotally, I feel lucky that I've owned a house in Canada for the last 15 years, right? Because apparently I'm a lot richer than I think. But I don't know, like I don't know anybody who trades houses or who gets in and out of them, or who, so I kind of agree with a lot of the points that Stéphane made yesterday about demographically and the quality of the foreign buyer that comes to Canada tends to be a bit better educated, aiming for a slightly better job, and maybe, that's created a real tailwind, especially, if you think about 300,000 immigrants a year, it feels like, sort of 40% of them are settling in Toronto, and they're not increasing the housing stock by 40% every year. So his point he also made about price per square foot in Canada actually not looking that expensive on a global basis was actually a very good point too. So I mean, I think it's something our bank worries about. I think that, again, I don't mean to speak for us, but I think if you were to look at our mortgage composition, it sounds to me like pardon me, most of the mortgages tend to be in that $1 million or less, which means they're not necessarily in big houses in Toronto and Vancouver, and I think that they're comfortable where they sit?
Yeah, well, I mean, I guess there's a couple of us that are Vancouver based. We live in Vancouver based, but I mean, Toronto's experienced the same appreciation over the last year and a half or whatever since this recent decline. I mean, from a credit investor perspective, we're not directly exposed to residential mortgages. Our exposure would be through the Canadian banks, and we feel very comfortable on their underwriting standards and everything that goes into how they manage those exposures. So, purely from a credit perspective, not particularly worried about it now. I didn't see I wasn't here for Stefan's presentation, but the supply constraints in both Toronto and Vancouver, just due to geography, I understand that should help keep things elevated here. But if there were a downturn, I wouldn't be quite as worried about the credit as far as the mortgages being repaid due to between the insurance and the down payments and everything else. I would be more worried about the general impact that it would have on the overall economy, because in Vancouver, I mean, I can't tell you how many people I know that are, engineers or nurses or whatever, and are a real estate agent on the side. Like, there's this whole market of, or people that are, were doing some other sort of work and then ended up going into contracting or whatever. There's this huge economy that is, like, the real estate market gets its tentacles into so many pieces of the economy, and just for folks that have seen their house prices rise and are using this, home as an ATM and supporting a lot of their consumption, because they know that the house they bought for $500,000 is now worth $1.2 million. So they have this $700,000 of additional equity that they can just sort of go out and spend now. So that's where my concerns would be on just having an overall impact on just the general economy if there were a turnaround.
Yeah, I would just. So I think you did a good job. The real estate itself is a separate issue than the economy, right? So the banks are held to a pretty high standard in Canada. We know that the loan to values are actually quite strong on average. They stress test the balance sheets as per requirements. And so the banks are actually almost impossible to break, at the big ones for sure. Mm-hmm. I would say that the standards in the individual lending are quite strong. I think the bigger issue is what happens when you get into an unemployment bulge and what the knock-on effects of that are. And again, I think we just have to rely on, we've got a very good sort of spectrum of things going on, including, the stress test that just came out. We've got a very good loan to value understanding. Like, there's a good collection of things that protect the banks from that risk, and the banks are very prudent in managing that, I would say. And I'd say, like in Equitable's case, we're actually a little bit different because we look at borrowers who don't have the big credit history. We spend a ton of time looking at borrowers, and the same borrower today that we would have lent to last year before B20. We're actually looking at that same borrower today, and they were good risk then under our internal stress test and how we looked at them. They still qualify under the B20 rules for the most part, and with some small sort of reduction. So I think, as a system, I think Canada is actually pretty good at getting ahead of these. When you compare it back to what happened in the United States in 2007-8, we don't have a lot of those things going on here in Canada. The other one, big difference in some of the leading states in the US was the recourse issue. We've got full recourse in most provinces here in Canada. So I see the risks as quite different in Canada than some of the other jurisdictions that have had similar problems.
Yeah, it's something. Yes, there was a very good station that was talking about, looking at, the different variables affecting the covered bonds and, the issuers. And I think the point that we're trying to make was that you need to take a broader risk assessment perspective. I mean, of course, the housing market is important, but at the end, you need to be looking at, okay, so what's the regulatory envelope? And, we heard yesterday that there have been lots of efforts in Canada to strengthen the underwriting criteria, to strengthen the banking and financial sector in general. So there is one layer there that seems to be solid or moving in the right direction. If you're talking about the covered bonds, for example, you need to look at the structure, the different mechanisms that are embedded in the structure of the bonds to absorb price corrections. You have the over collateralization ratio, the limit on the loan-to-value ratios as well. So, that's something that you need to consider. And then the overall economic background that in the case of Canada seems to be fairly positive and moving again in the same in the right direction. So you need to look at the whole picture, and yes, you need to focus on certain sectors like the housing market, particularly if you are analyzing a covered bond. But at the end, the perspective has to be very broad in assessment.
Good. Well, we are out of time. Any final questions before we break for lunch? I think one thing that we haven't touched on is the covered bond directive and the possibilities that were opened up for better prudential treatment for non-EEA covered bonds, but we'll be speaking about that elsewhere in the agenda. So before you go to lunch, please join me in thanking my panelists.
Thank you.
Thank you.